In the studio with me is Abdul Davids, who is the head of research at Kagiso Asset Management. Abdul, we were going along so nicely. I mean, I think 4 or 5 consecutive months of being above 50 and rising, and suddenly we plunged 6.6 points down to 47.6 in February of this year. Anything above 50 is expansionary for the manufacturing economy. Anything below 50 is a contracting number, so we're contracting again. What happened?
Yeah, unfortunately, we saw 2 of the bigger components of the PMI, the Business Activity Index, and then also the New Sales Orders Index coming down quite materially. Business activity in particular fell by almost a whopping 16.6 index points in February as well. Yeah. And we believe a lot of that had to do with the load shedding that we saw starting in November last year and obviously intensifying in January and February this year as well.
It's actually quite sad because we were going along quite nicely, and I got the impression that certain industries that have been under the cosh for the last couple of years were just starting to rebuild. As South Africans, I really believe that we are very adaptable to our conditions, and we had been adapting to those conditions, and then suddenly load shedding comes along. I don't think we quite realise how impactful and meaningful a couple of hours here and there of no electricity is to this country.
That's right, and I think the biggest concern, speaking to manufacturers anecdotally, is that they can't really plan ahead because you only know on the day what the stage is in terms of level 1 or level 2 in terms of the load shedding schedules. And albeit that we've got some clarity in terms of the duration, 2.5 hours typically, it's really the time of day that's critical. And for manufacturers in particular, you know, when you have manufacturing processes running long run or short run processes, you want to have that continuous manufacturing process. You don't really want to disrupt that. And unfortunately with load shedding, that is being disrupted at the moment.
Uncertainty, not good. Gugu?
Exactly, and on that uncertainty, Lindsay, Abdul, we recently had the budget speech from the finance minister, not really saying much that will bolster the manufacturing sector or see some kind of imminent resolution to the electricity crisis. When you speak to your colleagues in the industry with regard to manufacturing and the minister's budget speech, they're a little concerned that this issue is not getting enough attention.
Yes, unfortunately not. Clearly what we would like to see is great incentives for manufacturing. I think just the red tape to opening businesses, to assistance in terms of the admin side of things, to real capital allowances, capital incentives for manufacturers. Those would really be quite key in terms of an upswing in terms of manufacturing as well. The weaker rand has clearly helped, but I think that is being offset by disruptions from load shedding. The petrol price coming down has been a great boon to the sector. But we know that has probably bottomed, and we're likely to see petrol price and energy prices increasing from year on end.
Abdul, we've had the numbers from the Business Activity Index, a sub-index of the PMI, the New Sales Orders Index, another sub-index, but of course the social commentators, and quite rightly too, will be pointing to the Employment Index, and that hasn't done well. I noticed that we've been talking around the budget over the last week or so, and people saying, right, we've got to get this 24.5%, 25% unemployment rate down to, in the years ahead, down to 10 to 15%, which is a laudable target, but your employment index hasn't done well.
Yeah, fundamentally the problem that we have in manufacturing is that we've got surplus labor, and it's surplus of the wrong type of labor, to put it crudely. I think typically what we need is more skilled artisans, more skilled labor coming through, and unfortunately the labor that we've got surplus are the unskilled variety. If one looks at the manufacturing base in South Africa, it's really not conducive in terms of the type of labor that we've got, and the gaps that we currently have is in those semi-skilled and higher skilled levels where there's an acute shortage. So unfortunately, manufacturers are unfortunately caught between a rock and a hard place. They can't really expand because they don't have those critical skills, but yet they sit with the surplus labor at the low end.
Where does the Department of Home Affairs come in this regard, in letting a free movement of labour? Maybe those skills are available elsewhere in Africa, which has been booming relative to South Africa in terms of all sorts of indicators, like a PMI, like a GDP, etc. Is there a problem at various levels in South Africa?
I think it's a multifaceted problem, from the right schooling to the right tertiary institutions.
That's very, very long term though. I'm talking about short term, bringing people in.
Yes, I think fundamentally that is an issue as well. And whilst we might have some of those skills in Africa, the whole process of just getting them here is an issue. And clearly, you know, the reward structures that you need to set up around that is also an issue as well.
Prices is one index that is quite good. We've had a 4.4% print on CPI recently, consumer price inflation. We've had a 3.5% print on PPI, which was just last week, which is a good sign when it comes to monetary policies, a good sign when it comes to the PMI, because what it suggests to me is not only the oil price coming down, but also lack of demand.
It's a combination of the two. We've seen, for example, the prices index peaking in February last year at around 96. It's fallen by almost a third. It's now sitting around 60. And that clearly being driven primarily, we believe, due to low energy prices. Energy typically account for about a third of manufacturers' cost base. So with oil prices and fuel prices coming down, that is clearly a boon to the sector as well. Again, having said that, we know that there's a big petrol price increase coming on Wednesday. There's further increases down the road as well. And then also coupled with that, the intensive use of diesel generators, for example, by manufacturers is really adding cost to the bottom line. So you're caught again between those intricacies in terms of the cost movements that we are currently seeing as well.
Abdul, almost sounds to me as though it's a rock and a hard place. Given this dim outlook, what are you anticipating will happen to PMI going forward in the next 3 months?
I think what we need is some stability in terms of just operating conditions. And clearly with load shedding, I don't know what the future is for load shedding, whether it will intensify over the next 3 months. But that's clearly a very short-term critical issue we need to address right now. If one looks at the global context, we are seeing UK PMI, Eurozone PMIs firming. The Chinese PMI is still hovering around the 50 level as well. And these are big trading partners as well. And where the currency is currently, we should see some of that benefit. And hence we're seeing the expected business conditions index comfortably above 50, at around 66, for example. But the real challenge and the frustration is that we can't really have manufacturers operating at optimal conditions given the disruptions that we're seeing currently in the South African context.
Abdul, thanks very much for popping in this lunchtime. That's Abdul Davids, who is the Head of Research at Kagiso Asset Management.